If you're drowning in federal tax problems, you may be considering Chapter 13 bankruptcy so that you can get some type of relief. Well, we're going to look at Chapter 13 bankruptcy, but I'm not going to go into procedures about things such as credit counseling or anything like that. Our focus here is going to be on how a Chapter 13 bankruptcy will affect IRS wage garnishments, federal tax liens, and federal income taxes that you owe. Now, I'm not giving you tax or legal advice. You should consult with both your attorney and your tax advisor so that you can try to get the maximum amount of your debt wiped out in bankruptcy. You probably already know that the IRS can seize or place liens on your assets, take your future tax refunds, and garnish your wages. When you file a petition for Chapter 13 bankruptcy, a wage garnishment, tax levy, and any type of collection or enforcement actions are stopped. Even tax court proceedings will be stopped for any tax debt that you owe for tax periods that ended before the bankruptcy petition. If you're currently in tax court, the bankruptcy court can decide whether the bankruptcy court or the tax court will handle the tax case. So if it decides to do so, the bankruptcy court can push your tax issue back over to the tax court. When it comes to a wage garnishment, the IRS can set it up without even going to court. Typically, the IRS will take 3 steps before garnishing your wages. First, they will send you a demand for payment and tell you how much you owe in taxes. Next, they will send you a final notice of intent to levy. And finally, they will send you a notice of your right to a hearing. At this point, you can make an appeal. Of course, you never want a wage garnishment because the IRS can take a huge chunk of your paycheck. The amount that the IRS will take depends on how much you owe in federal taxes, but the table on your screen will give you an idea of how much the IRS can leave you with to live on after they take their cut. For instance, for 2024, if you're a single with no dependents and get paid monthly, the IRS can leave you with $1,216.67 to live on per month. When it comes to a lien, if the IRS does not file a notice of federal tax lien before you file for bankruptcy, they cannot file one during your Chapter 13 bankruptcy case. If the IRS files a notice of federal tax lien before you file for Chapter 13 bankruptcy, the IRS will have a secured claim that will remain attached to all of your assets, and you will have to pay the claim through your bankruptcy payment plan. Timing can get a little tricky because you may want to file bankruptcy before the IRS files a tax lien, but at the same time, if you file for bankruptcy too soon, you would miss out on being able to wipe out additional tax debts that could be discharged if you were to wait a little longer. If a lien is filed, the good news is your equity in the assets covered by the lien is frozen once your bankruptcy plan is approved. The claim for the lien will be no more than the value of your assets in your bankruptcy schedules, but the claim will not take into account any exemptions. For example, let's say that you have $50,000 in assets on your bankruptcy schedules, you have $20,000 in exemptions, you owe the IRS $60,000 in dischargeable tax debt for 2019. You owe $25,000 in non-dischargeable tax debt for 2023. And the IRS has already filed a $60,000 lien. The IRS could be the kinder...
Miss Stratford?
Come in, Mr. Griffin. Don't be nervous. The IRS is much kinder and gentler than we used to be.
Gentler IRS from the 1990s and applied $25,000 of the lien against your 2023 tax debt and $35,000 of the lien against your 2019 tax debt. Applying some of the lien against the 2023 tax debt that has to be paid anyway would allow more tax debt for 2019 to be discharged. So only $60,000 would have to be paid in full out of the $85,000 that you owe, leaving $25,000 available to be wiped out in the bankruptcy. Unfortunately, more than likely, what the IRS would do instead is apply the entire lien against your $60,000 tax debt for 2019 so they can collect the most money. The IRS would still be limited by your $50,000 in assets for 2019, but they are not limited by this amount for 2023. If the IRS does it this way, you would have to pay $50,000 in full for 2019, and you would have to pay $25,000 in full for 2023. So you would pay a total of $75,000 in full, and the remaining $10,000 that you owe for 2019 would be thrown in with all your other debts that can be discharged. After you make all of your planned payments and your bankruptcy is complete, and if you still owe an amount on the $10,000 tax balance, this remaining balance would be wiped out. As you can see, in this scenario, you can only have $10,000 wiped out compared to the other scenario where you could have $25,000 wiped out. Let's look at another example. We will say that your only asset is your house and there's a federal tax lien against you for $60,000 in dischargeable federal tax debt. When your bankruptcy plan is approved, your house is worth $400,000, but you have a $390,000 mortgage and you owe $15,000 in property taxes. This means that you don't have any equity in the house at the time of filing because you owe $405,000 for your mortgage and property taxes combined. As you pay down on the mortgage and once you pay the property taxes, you would build equity over time. With Chapter 13, building equity over time doesn't matter. Since you don't have any equity in your house when your bankruptcy plan is approved, that $60,000 tax debt that you owe can be discharged at the end of your bankruptcy just like your other unsecured debts. So in this case, even though there is a lien, that entire $60,000 has become a debt that potentially can be wiped out. Now let's look at how Chapter 13 works for federal tax debt that you owe. You probably already know that you have to have regular income to file a Chapter 13 bankruptcy, and only individuals and sole proprietors can file a Chapter 13. Basically, Chapter 13 gives you time to repay some or all of your debt. There's a debt limit, though, in the amount of $2,750,000 for your secured and unsecured debts combined. This limit is temporary, and it doesn't matter if the debt is secured or unsecured. This limit is set to revert back to lower limits in July of 2024. The lower limits will revert back to $1,395,875 for secured debts and $465,275 for unsecured debts. The limits are adjusted every 3 years, so you should always check for the latest limits. Once you file for bankruptcy, the IRS will file a claim with the bankruptcy court just like any other creditor. The IRS can file a claim even if taxes have not been assessed. So when looking at the debt limits, you should include your federal tax debt. Only taxes on income or gross receipts can be discharged. To be discharged, the income or gross receipts have to be for tax returns due more than 3 years before your bankruptcy petition date. The 3 years is from the date the return is due and not from the date when you filed your return. You had to have filed these tax returns 2 or more years before you filed for bankruptcy. Your federal tax debt will not be discharged for any year that you did not file a tax return. If the IRS prepared a substitute return and you did not assist the IRS in preparing the return and you did not sign the return, the substitute return will count as an unfiled return. If any part of your tax return is considered to be fraudulent, or if you try to evade or defeat your tax debt, you won't be able to discharge any tax debt associated with that return. You will have to be careful with your 3 years though, because if the IRS assessed the tax debt within 240 days before you filed for bankruptcy, that tax debt cannot be discharged. For example, if you were to file for Chapter 13 bankruptcy in January of 2025, you would have to pay the full amount of your tax debt for 2021, 2022, and 2023 for returns that were due in April of 2022, 2023, and 2024. So most of your tax debt before 2021 can be discharged. But let's say that you were being audited by the IRS for your 2019 and 2020 returns, and in October of 2024, the auditor determines that you owe additional taxes for these years. These additional taxes cannot be discharged because the additional taxes would fall within the 240-day period before you filed for bankruptcy. This means that the additional taxes assessed by the auditor must be paid in full. So you want to make sure that you pay close attention to all your dates. With this in mind, you should never take guesses with any of your dates. You should order tax transcripts directly from the IRS because you don't want any discrepancies. Also, you want to make sure that you did not make an offer in compromise and you did not file a collection due process appeal. These 2 things will impact the 240-day period. For Chapter 13, you have to file all of your federal tax returns that were due within the 4 years before you filed for bankruptcy. You have to do this by the first meeting of the creditors. After you file for Chapter 13, a trustee will be assigned to your case, but you won't have a separate bankruptcy estate. You will continue to file your regular 1040 federal tax return. Please make sure that all tax returns that become due after you file for bankruptcy are filed on time, or you should file an extension. Please make sure to pay your taxes on time for these tax returns. If you don't file your tax returns on time, your bankruptcy case can be converted to a different type of bankruptcy or dismissed altogether. If you're not withholding enough in federal income taxes from your paycheck, you should change your withholding amount because you don't want to give the court any excuse to dismiss your case. I will include a link to the Withholding Estimator in the description box. If your federal tax debt does not meet the criteria, then that tax debt must be paid in full. This debt will be included in your bankruptcy payment plan. Your payment plan will be from 3 to 5 years. Also, more than likely, your attorney will try to make sure that amounts that must be paid in full are paid first, so at the end of your bankruptcy case, you will owe nothing or very little in tax debt. At the end of your bankruptcy case, you will probably have a balance remaining on your credit cards and other bills, but these bills will be discharged. Speaking of credit cards, if you used your credit card to pay federal taxes that cannot be discharged, a Chapter 13 will let you discharge the credit card debt as long as you originally intended to pay the credit card. Under Chapter 7, you wouldn't be able to discharge this credit card debt. By the way, you can actually receive tax refunds while you're in bankruptcy. More than likely though, any refunds will be used to pay down your tax debt, or your refunds may be delayed, but at least there is some possibility that you might get refunds. Each year, you can always check the status of your refund on the IRS website. I will include a link to the website in the description box. The statute of limitations to collect your tax debt will be paused while the bankruptcy is pending. Normally, a bankruptcy is pending from the time you file until there's a final resolution to the bankruptcy. This includes dismissal. This means if something goes wrong and you can't complete your bankruptcy case, the IRS will still have time to collect on your old tax debt. If you can't complete all payments under your Chapter 13 plan and the court decides that it's not your fault, then the court may give you a hardship discharge. With a hardship discharge, you will have to pay your unsecured creditors no less than they would have received under a Chapter 7 bankruptcy, and the same tax debts that can't be discharged under a Chapter 7 cannot be discharged in a hardship situation. As you can tell, since you will have to repay part or all of your tax debt under a Chapter 13 bankruptcy, Chapter 13 may not be your best option for real financial relief. If you meet certain income requirements, you might qualify for Chapter 7 bankruptcy. If you want to know more about Chapter 7, please watch the video in the upper left of your screen. While it's possible that with a Chapter 13 you might get a lower monthly payment than with a regular installment agreement, you may end up paying more overall because of the trustee's fee that you pay in a bankruptcy. If most of your tax debt cannot be discharged, you might want to check into an installment agreement or maybe an offer in compromise instead. Actually, you should check into these options before you file for bankruptcy anyway. With an offer in compromise, the IRS will settle your federal tax debt for less than you owe. If you want to know more about an offer in compromise, please watch the video in the lower left of your screen. I hope things go well for you.